This week, I took 11 trades on E-mini S&P 500 futures, and every single one followed the same exact process. There were no random entries, no guessing, and definitely no chasing the market after it already moved. Every trade started by identifying high probability location using statistic inside StatsTerminal. Once price reached one of those areas, I checked the market profile to understand the auction. And finally, I waited for the order flow to confirm whatever buyers or sellers are actually taking control. Throughout this video, I'll walk you through every trade I took, explaining what was I seeing in real time, why I entered, how I managed the trade, and what I learned from each setup. If you're trying to become more consistent as a future trader, I hope this video shows you that profitable trading isn't about predicting the futures. It's about patiently waiting until multiple pieces of evidence line up before putting capital to work. Let's jump into the charts. Before we go through each individual trade, I always like to start with the bigger picture, because that's where every trading day begins. Every weekend, I build a complete trading plan for the upcoming week. Instead of waking up each morning and wondering what the market might do, I already know the important areas I want to pay attention to. I'm looking at StatsTerminal and I review the higher time frame support and resistance statistics, hourly statistics, profile statistics, overnight statistics, initial balance, RTH open, and time of the day reversal statistics. This helped me to not predict the future. Instead, they identify areas and times when the market has historically shown a higher probability of reacting. Once price reaches one of those locations, my focus completely changes. I'm no longer looking at the statistics. I'm watching over the order flow. I want to see aggressive buyers, aggressive sellers, absorption, exhaustions, etc. And also whatever larger participants are actually stepping into the market. Only when those pieces line up, I take the trade. If they don't, I simply wait. Patience is one of the biggest edges a trader can have. Now let's look at the first trade. So the first trade happened shortly after market opened. Price pulled back into the VWAP for the very first test of the session. Market profile also show a low volume node just underneath the price. Low volume node often becomes rejection area because the market previously moved through those prices very quickly. So when the price tested VWAP, I started watching the order flow, and instead of seeing aggressive sellers continue to push in lower, buyer began to absorbing the selling pressure while liquidity built underneath the price right there. That was my confirmation I needed. I entered long, took my first target fairly quickly, reduced the risk, and then trail my stop. The second setup came at value area low. This is one of my favorite market profile levels because it's often acts as an important decision point. Instead of buying immediately, I waited for the order flow confirmation. As price traded into value area low, several large buy orders began hitting the tape while sellers struggled to push the market lower. That's told me that larger participants were becoming more active. This trade also something I have working on recently is holding winner longer. Instead of taking profit too early, I will allow the trade to develop and capture over 25 points. What have I learned from this? The biggest lesson wasn't the entry. It was the trade management. Sometimes improving your results doesn't require finding a better setup, right? Sometimes it simply means stretching your analysis and allow your winning to run. Trade number three was developed around the regular trading hour opening price. Inside StatsTerminal, I track how often the market react around this level because it's frequently become an important reference price during the day. As price approached that level, I noticed liquidity was building on the heat map. Then the buyer become aggressive on the tape. That confirmation was enough for me to enter. After taking a partial profit, I left the runner to capture additional movement. This trade enforced how powerful reference prices can be. The RTH open isn't magical. What makes it valuable is that so many market participants pay attention to that level. When those levels align with order flow, they become often very high quality opportunity. Trade 4 and 5. These two trades are a perfect example of why confirmation matters. Um, the trade was a VWAP bounce that actually the first try failed and the second one was okay. So buyer never truly stepped in on the first time. There was no big print before I entered. So I lost on that trade, but then I noticed that the 230 print happened. So I decided to wait for a little bit more confirmation and then I entered. This time the order flow looks completely different in my opinion. Large buyers began printing aggressively. The tape showed the buyers and gives me more confidence to re-enter the trade. The second trade worked. Not every trade is a winner. um, what have I learned from this? Trading level should never be judged from a single attempt. The first attempt failed, the second won, right? The difference wasn't the VWAP, the difference was the order flow. I'm never trying to predict what a level will do. I'm waiting for the market to confirm the idea. Trade 6 and 7. It's all about the initial balance failed auction. Both of them were a win. One of my favorite setups occur around the initial balance low. The market attempted to auction lower, but immediately failed to attract additional sellers. Instead, aggressive buyers step into the market. This is exactly what I look in a failed auction. Once the rejection become obvious, I entered long. The trade worked well. Later price returned to retest, basically double bottom. Once again, I enter with the buyers since the setup remained valid. What have I learned from this? Failed auction can produce some of the stronger reversal of the day, if you especially if you combine it with the time of the day. Instead of trying to predict the bottoms, I wait for buyers to prove that they're taking control. That simple rule saved me from countless unnecessary losing trades. Trade 8 and 9. These trade also occurred around the initial balance. I was going for a failed auction. Um, the 8th trade, which I didn't record, but it was a loss. As you can see here on the chart, um, it just didn't work. My stop was in the wrong place. If I put the stop below the swing low, would probably be okay. But I didn't want to take the chance, so I took the loss. But when the price returned to the same level, I retry and I notice the same exact absorption on the order flow. So this time I gave him a little bit more of a room for my stop. And then the market reversed. The trade number 9 was the winner. What do I learn from this? This is probably the biggest lesson of the week. Sometimes your analysis can be completely correct, but your execution isn't, right? Proper stop placement is just important as finding the right setup. Trade number 10 was the morning VWAP short. This setup is simply the opposite of trade number 1. Instead of looking for buyers, I was looking for sellers. Price rally back into VWAP for the first mini test in the morning. Order flow showed aggressive sellers entering while buying struggling to continue higher. That was all the confirmation I needed. I entered short, took partials like normal, and reduced my risk and allowed the remaining position to continue. One thing this trades remind me is that consistency comes from repeating the same exact process, right? Whatever I'm buying or selling, it doesn't matter. My checklist never changed. Statistic, market profile, order flow, all three of them are aligned, and I take the trade. Trade number 11 and also the final trade of the week, and actually occur on a high time frame support level from the 4-hour chart. Higher time frame levels often attract larger institutional participation, so I always pay attention when price reach those levels. As the market tested support, I also noticed a significant liquidity appearing on a heat map. Order flow confirmed the aggressive buyers that stepping into the market. With the higher time frame support, liquidity, order flow, all aligned, the trade met every rule in my trading plan. It was a great way to finish the week. What have I learned? Always look at the higher time frame. A higher time frame provide valuable context. When the higher time frame align with the strong order flow confirmation, it normally produce a good trade. Looking back at all 11 trades, what stand out is that not all of them were winning trades, right? Is that every trade followed the same exact decision-making process. There were no impulsive trades, no chasing, no revenge trading, just waiting for statistically important location, confirming them with market profile, and letting the order flow tell me when buyers or sellers were actually in control. That's the process I repeat every single trading day. Trading doesn't become easier because you learn to predict the future. It becomes easier when you stop trying to predict and start watching for confirmation. If you enjoyed this breakdown, let me know in the comment which trade taught you the most or which setup you'd like me to break down in more detail future videos. If you found this valuable, don't forget to hit the like button and subscribe. And for more weekly trade review and order flow education, check StatsTerminal.com. Thank you for watching, and I'll see you in the next one.